Most people believe inflation is a universal villain, quietly stealing from everyone equally. But what if that belief is dangerously incomplete? And what if the real story is that inflation is not a mistake at all, but a feature of the system that quietly transfers wealth upward, while most people are distracted by rising grocery bills and rent payments? Because somewhere in this chaos, someone is winning, and the winners are not who you think. Welcome to Meta Finance Lab, where you can get more informative videos related to finance. You can subscribe to the channel for timely updates. To understand who benefits from inflation, we need to rewind to where it all begins, because inflation does not simply appear out of nowhere like a natural disaster. It is born inside financial systems, policy decisions, and human behavior. And once you see how it starts, the rest of the story becomes disturbingly predictable, even if the details change from decade to decade. In simple terms, inflation happens when there is more money chasing the same amount of goods and services, and while that sounds abstract, think of it like a crowded auction where everyone suddenly has extra cash. Prices go up not because things are better, but because people can pay more and the seller has no reason to charge less. Historically, inflation often accelerates after major events like wars, pandemics, or financial crises, when governments step in to stabilize economies by injecting massive amounts of money. And this is where the first twist appears, because the money does not enter everyone's pocket at the same time or in the same way. When new money is created, it flows first through banks, financial institutions, corporations, and government contractors long before it reaches everyday workers through wages. And by the time it does, prices have already adjusted upward, quietly eroding purchasing power for those at the end of the line. This phenomenon is not new, and economists have observed it for centuries, but it rarely makes headlines because it sounds technical, yet its impact is deeply personal, determining who can afford homes, who accumulates assets, and who lives paycheck to paycheck despite working just as hard as ever. Consider the early 1970s in the United States, when inflation surged after the gold standard was abandoned. Wages struggled to keep pace with rising prices, but asset owners, particularly those holding real estate and stocks, saw the value of what they owned increase dramatically over time. Here is where the story becomes uncomfortable, because inflation punishes savers but rewards borrowers, and that single sentence explains a massive portion of modern wealth inequality, even if it does not feel obvious in daily life. If you have a fixed-rate mortgage and inflation rises, the real value of what you owe shrinks over time, meaning you repay your debt with dollars that are worth less than when you borrowed them, effectively giving you a discount funded by the broader economy. Now flip that scenario. If you are a saver holding cash or low-yield savings accounts, inflation steadily eats away at your purchasing power, turning what feels like responsible behavior into a silent loss that rarely triggers the same emotional reaction as a market crash. This is why governments with high debt often tolerate or even quietly welcome moderate inflation, because it reduces the real burden of what they owe. And while no politician says this directly, the math works in their favor as long as inflation does not spiral out of control. But governments are not the only beneficiaries, because large corporations with pricing power often thrive during inflationary periods, especially those selling essential goods like food, energy, and housing-related services, where consumers have little choice but to pay higher prices. You may have noticed headlines about record corporate profits during times when consumers feel poorer, and this is not a coincidence, because companies that can raise prices faster than their costs effectively use inflation as a profit multiplier. Meanwhile, workers face a different reality, because wages tend to lag behind inflation, not due to conspiracy, but due to negotiation cycles, contracts, and employer caution, meaning real income often falls even when nominal paychecks increase. This lag creates a psychological illusion where people feel they are earning more, yet somehow falling behind, and that confusion keeps the focus on personal budgeting rather than systemic forces shaping the outcome. Another group that benefits quietly from inflation is the financial sector, particularly banks, which earn money by lending at higher interest rates while paying depositors less than the rate of inflation, capturing the difference as profit. This spread becomes especially powerful during periods of rapid inflation, when borrowing becomes expensive, but existing loans reprice upward faster than savings rates, locking in advantages for lenders. At this point, you might be wondering whether inflation is simply unavoidable, or whether attempts to fix it actually make things worse, and this is where the story reaches its breaking point. Central banks typically respond to inflation by raising interest rates, aiming to slow borrowing and spending. But this medicine often hits the most vulnerable first, increasing unemployment risk and making housing less affordable for new buyers. Ironically, those who already own assets are often insulated from these shocks, while first-time buyers and younger generations face higher barriers, reinforcing the same inequality inflation helped create in the first place. This pattern has repeated across countries and decades, from post-war Europe to modern emerging markets, where inflation reshuffles wealth upward before stabilizing, leaving lasting scars on social trust and economic mobility. Even when inflation eventually cools, the gains and losses remain unevenly distributed because prices rarely fall back to previous levels, while wages and savings take years, if ever, to catch up. The failed fixes often involve treating inflation as a temporary glitch rather than a structural feature, leading to cycles of stimulus and tightening that solve symptoms without addressing underlying incentives. Modern parallels are impossible to ignore, as recent years have shown how quickly inflation can return, reshaping daily life, housing markets, and political debates, all while quietly benefiting those positioned closest to newly created money. So who actually benefits from inflation? The answer is not a single villain or hero, but a system that rewards asset ownership, debt leverage, and pricing power, while penalizing cash savings and fixed incomes. The first takeaway is that inflation is not neutral. It redistributes wealth, often upward, regardless of intent or rhetoric, and understanding this helps explain why it persists despite public frustration. The second takeaway is that personal financial outcomes during inflation depend less on effort and more on structure, including what you own, what you owe, and how quickly your income adjusts. The third takeaway is a warning, because ignoring inflation's winners allows the pattern to repeat, while informed citizens and investors at least have the chance to adapt, question policy, and protect themselves in a system that was never designed to be fair by default. And that uncomfortable truth is worth sitting with before the next inflation cycle inevitably arrives. Meta Finance Lab brings you useful knowledge and insights to help you understand the world of finance. Subscribe to stay informed and share with others who need this information.